Before we begin, just a quick note. This podcast is produced by qualified financial professionals and is intended to share general information and insights to help expats better understand common financial topics. However, everyone's circumstances are different and regulations can vary by country, so nothing discussed should be taken as personal financial, tax, or investment advice. If you're considering making financial decisions based on anything covered in this episode, we recommend seeking professional advice tailored to your individual situation.
Welcome back to Expert Money Matters. I'm your host, Georgina. At Chase Buchanan, we monitor global market shifts to turn uncertainty into opportunity. To provide you with total clarity, we've transformed our weekly market update email into this convenient audio format. Here is your weekly market update for March the 18th, 2026.
Good morning or good afternoon, depending on where in the world you're joining us from. As the conflict with Iran enters its third week, financial markets are, at least on the surface, showing a commendable degree of composure. Despite the headlines, investors seem to be holding their nerve. As of Friday's close, the All Countries World Index was down 6% from its February 26th all-time high. Interestingly, the movements we saw last week were actually more measured than the initial volatility of week one. US equity markets have fared better than most. This is largely because the US holds a few relative advantages right now, specifically improved terms of trade compared to other major economies. Being a net exporter of oil and gas is a massive buffer. We're seeing that strength reflected in a decent rally for the US dollar against both the pound and the euro, especially when you look back to where it was trading at the end of January. Turning back to the conflict itself, are we any closer to divining an outcome? If we look back a couple of weeks, the biggest surprise for almost everyone, including it seems the US government, has been the sheer scale of Iran's response to the initial attacks. The Middle East experts I've been following generally agree on one thing: as long as the current regime feels that its survival is at stake, it will stay the course. That, unfortunately, does not bode well for a quick resolution. From a market perspective, this creates non-linear tail risks. The longer this continues, the more we have to worry about energy supplies and other key commodities. We're already seeing oil production being curtailed because of a lack of storage facilities. It's important to remember you can't just flick a switch and bring production back online the moment the situation improves. There's also the very real risk of further infrastructure damage, which could keep refining capabilities offline for even longer. Looking at the headlines today, President Trump has been discussing the strikes on Kharg Island, the primary hub for Iranian oil exports to China. While oil infrastructure has been mostly spared so far, the president has threatened to hit it harder. Meanwhile, there's significant chatter about a global alliance to escort tankers through the Strait of Hormuz, alongside further US threats toward NATO. We're also seeing reports that Tehran might potentially grant safe passage to certain countries. Both CNN and Bloomberg are reporting no sign of an imminent negotiated settlement. In fact, the Pentagon and Israel both expect the war to extend for several more weeks. Since we have very little hard evidence to base our forecasts on, we have to remain vigilant and monitor the situation as it evolves. On the economic data front, in a parallel universe, we might have been discussing interest rate cuts from the Federal Reserve and the Bank of England. But not in this one. This will be the first real opportunity for central bank policymakers to respond to the crisis. All eyes will be on the official statements and press conferences. The big question is, will they be prepared to look through inflation caused by supply chain disruptions? This is a different beast than the excess demand we saw in 2022. Or will they focus primarily on keeping long-term inflation expectations anchored? Beyond the Fed and the BOE, we'll also be hearing from the central banks of Switzerland, Canada and Norway, as well as the ECB. As for the hard economic data, its main use right now is showing us what kind of momentum the global economy had leading into March. We already saw a few wobbles in February's US employment numbers and that disappointing January GDP data out of the UK. Even so, and I say this in hushed tones, there was little to suggest that global momentum was slowing dramatically in February. Some of the soft data compiled over the last fortnight might give us early clues about the economic reaction to the war, but for now, staying alert to the immediate volatility remains the order of the day.
And that wraps up this week's Market Snapshot. If you'd prefer to get the information before it's published here, you can sign up for the update directly on our website. Just visit chasebuchanan.com and subscribe and get the update delivered straight to your inbox, giving you a head start on the week. Thanks for listening to Expert Money Matters. I'm Georgina. Join us next time as we explore money matters for your life abroad.